Hi, I'm Jay Taylor. Welcome back to the Metals Investor Forum. This block of companies. We've got three very exciting companies that I really love. I have in my newsletter that I follow and also own shares myself. So I'm really looking forward to hearing what they have to say. I'd just like to let you know that I publish a newsletter, Jay Taylor's Gold, Energy, and Tech Stocks, and host a radio show every Tuesday at 3 o'clock New York time on the Voice America Business Channel, and you can listen to that or listen by way of a podcast on the following day. I've titled my show, I titled my presentation as this is the time when we're going to see a major change away from, essentially away from fiat currencies into the real, into real money, that is gold, and for reasons that I'll be explaining shortly. A book that I've recently read, actually read a number of years ago and then reread again, is The Fourth Turning by two authors, Strauss and Howe. Essentially, I think it's very important now because I think the things that we're starting to witness in the economy as well as sociologically are explained in this book. Every 80 to 100 years, every 4 generations, societies have major changes in the way they view things, their religion, their social ideas, ideas about what is right and what is wrong, how we should live together. It changes very dramatically. And this is now the fourth turning for America. The last one was the 1930s, the Great Depression. The prior one was the Civil War. And before that, it was the birth of America in 1776. So these are very big events. And it's very, very much attached to what I'm going to be talking about now in this presentation. Just a couple of quotes from the authors of this book. At some point, America's short-term crisis psychology will catch up to the long-term post-unraveling fundamentals. This might result in a great devaluation, a severe drop in the market price of most financial and real assets. This devaluation could be a short but horrific panic, a free-falling price in a market with no buyers, or it could be a series of downward ratchets linked to political events that sequentially knock the supports out from under the residual popular trust in the system. As assets devalue, trust will further disintegrate, which will cause assets to devalue further, and so on. Every slide in asset prices, employment, and production will give every generation cause to grow more alarmed. This book was written in 1997, and the authors were suggesting that the next turn would come sometime, for America would come sometime in the middle of the 2000s. And I would suggest they happened with the financial crisis of 2008 and then the Obama administration. Another quote I'd like to read real quickly, Ludwig von Mises, the famous Austrian economist, said, "There is no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as a result of a voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved." Well, when it comes to bankers and to politicians to think that they would take on some voluntary policy that isn't pleasant is like asking an alcoholic to stop drinking. It's almost impossible. I'd like to introduce to you Lynn Alden, who's written a wonderful paper recently. I've actually had her on my show a couple of times. She's gained a lot of notoriety in recent months. She is an engineer by trade, but has also been involved in the financial markets for quite a few years now. And she's just recently written a paper that I think is very important, September 17th, a century of fiscal credit, fiscal debt, money, and policy, and the idea of inflation versus deflation that occurs at certain points in the long cycle. Essentially from this paper, what I got from it and what I'm going to be talking about today, because I think it's so apropos with what's going on. Short-term debt-induced recessions can be avoided with monetary policy. So we have our usual business cycle, our usual credit cycle, and it's overcome by money printing and massive amounts of money pumped into the banking system. But the problem with each new cycle, we begin at a higher level of debt to GDP. than we had at the start of the prior cycle. And by the fourth such cycle, or let's say the fourth turn, there with zero bound rates, that's really the important factor, is when rates get to zero, is that monetary policy becomes impotent. And fiscal policy combined with hyper currency inflation is required really to redistribute wealth from the rich who have accumulated wealth over the last number of money printing years. When monetary policy was pumped into the system, those that are wealthy tend to get wealthier, and to redistribute wealth to restore stability into the system. So here's one of many of the charts that I'm taking from Lynn's presentation. We see this as a very normal chart. We see these cycles: the business cycle, the non-financial, the private sector comes down, has a recession, and the government starts pumping money into the system, or let's say not the government, but the central banks pump money into the system. And after the recession, it sort of seems to help, and we have another cycle. But each of these cycles, the debt gets larger, and the money keeps getting printed. That's printed as more. It's never allowed to come back to some sort of equilibrium level. And each new cycle requires lower interest rates. The tolerance for higher rates goes down to lower levels with each cycle. Why? Because the debt is increased so dramatically that the system can't stand higher rates. And so Lynn's point is that when we get to zero bound rates, which we did in 2008, and we tried to normalize, the Fed tried to normalize the balance sheet and interest rates, but we only got to about 2.5% on the short rates before the system started to topple over again. So this is a chart that shows interest rates, short-term rates. Now you'll see the spike was in 1980 when Paul Volcker put the brakes on money creation, causing interest rates to rise very dramatically. But when he took his foot off the brakes and started putting the pedal to the metal, we see what happens. Debt grows very dramatically, and everybody is having quite a party for quite a few years with the equity markets and financial assets. Again, this is showing debt as a percentage of M2. Now, debt goes down relative to M2 when we get to the zero bound level, when interest rates hit zero, because people are in trouble, they can't borrow, people can't spend, they're broke essentially. The masses, the middle classes have no money, they're not buying things. Companies aren't borrowing because they don't see the prospects of building their businesses. And so the government can pump money into the system, M2, measured as M2 in this case. And so the denominator goes up. The debt doesn't go down, but the ratio goes down of total debt to M2 because monetary policy is becoming impotent. Again, this is Lynn's chart here shows the zero bound levels in the 1930s, the last time it happened. When monetary policy didn't work. And so we're seeing here the monetary base is skyrocketing, as it did in the 30s and during the Second War. So we printed tremendous amounts of money. Tremendous amounts of money were printed, and it just really didn't work. The main reason it doesn't work, as I just said, companies won't borrow, banks won't lend, because people aren't spending. So the the money multiplier, if you will, banks don't lend, and so the fractional reserve system doesn't take off, business doesn't grow, and so monetary policy no longer works when you get to this level, the zero bound level. A chart from Lynn again here shows back in the 30s compares with where we are now. We see this, the gray lines of the federal deficit showing fiscal monetary or a fiscal stimulus, and then we have this long period when monetary system seems to work, but again we're putting yield, we're putting debt upon debt with each cycle. Again, you'll see the yield. There was yield curves. There was yield curve control back in the 30s. We haven't seen it formalized yet, but I would argue that we're having yield curve control now simply by the Fed pumping money into the system. Even though it isn't working, it's keeping a lid on the interest rates. So what happened up until a certain point in time, we had a non-inflationary devaluation, which you can argue that we're having now. Although I have a problem with this data, with this inflation data, because during the Reagan years, they started calculating inflation much differently. They started employing hedonic pricing and substitution into the inflation rates. If you follow the work of John Williams, an independent economist, he maintains that we're much closer to 10% in inflation right now, which then, of course, really kicks the legs out from under GDP. So John's work suggests that we haven't really had any real GDP growth for quite a few years, certainly since 2008, or before that, actually. So back in the 30s, they devalued the dollar. Gold was of course taken away from the people, and the dollar was revalued upwards from $28 and change to 35, thereby devaluing the dollar. I would argue the same thing is happening now, but just not formally, because as the Fed prints, the gold price is going up very dramatically. So we're seeing non-federal debt growing very dramatically right now, and we're starting to see massive fiscal deficits. Will the Fed cap the Treasury yields? Yes, I think they already are to an extent, but they might do it more formally into the future. As to why monetary policy is emasculated at zero bound, this shows, I think, tells the story. This shows the top 1%, excuse me, the top 1/10 of 1% owning as much wealth as the bottom 90%. And this hasn't happened until, we have to go back to the 1930s to see this happen. But what it means is essentially the people that will spend most of their money on goods and services don't have the money to spend. So monetary policy is emasculated. It doesn't work anymore. It's impotent at this point in time. The other thing is that by artificially lowering interest rates, capital goes into bad usages. And so as the cycle matures, what you see is it takes more and more money, debt money created in order to create $1 of income. And so in this case, right now, it's closer to $7.50 of new debt for every $1 of GDP that's created. So what happened during the 30s is going to happen, and I think is already starting to happen. They capped the rate on the treasuries. And so the nominal yield was, or the nominal amount of $10,000 grew to $12,694. But the real growth, because of the decline in the dollar, was $6,754. So the people that were savers into the treasuries, they really didn't do very well. And we're seeing the same thing happen right now as the gold price in the chart lower left compared to 10-year yields. So the question that I have, if real rates are negative and the dollar heads south in terms of its purchasing power, which it most certainly will, as trillions upon trillions of new dollars are printed to finance fiscal policy, then why in the world would people not cross over from the US Treasury dollars to gold? And that's exactly what they're doing. Very quickly, because I know I'm going to run out of time, the fourth turning suggests also that there could be major geopolitical changes, and I think they are already underway. With the relationship between Russia and China, and the Chinese taking the savings that they've earned over many decades, their net exports, and financing, using that wealth that they accumulated to build the one brick, one road, to unify and to bring many countries together in trade. And this is something that most certainly the United States is very concerned about. Money flows to countries when they become wealthy. Gold flows to countries when they become wealthy. Russia and China have been accumulating official reserves dramatically. And the United Kingdom, you can see by contrast what it's done with its gold. And China, in terms of total gold, under the official reserves in the purple here in this chart, is just part of the story. The bigger story is their mining. They're the largest gold miners in the world right now. So you see the light blue, and then the amount of gold that the country is importing. Dramatic increase in gold accumulation in China. Gold is flowing to the countries that are becoming wealthy, and they're flowing away from the countries that are losing their wealth and are in decline. The fall of the empire, I'm not ready to say it's a fall yet, but I think certainly a decline in the American empire is underway. And I'll just point to a couple of statistics here. The US GDP up 4 times since 1969. The Chinese up 175 times, admittedly from a very low base to start with, but nonetheless a torrid rate of catch-up. And just also point out gold's performance to the Dow Jones, very dramatic. Stephen Roach at Yale and longtime Morgan Stanley has been preaching for a long time about the United States not saving enough and living off the kindness of strangers, and has been really predicting that the dollar is going to be in some trouble now, especially as our savings rate, our collective savings rate as a nation, is in decline as the United States goes into debt more and more to finance fiscal. He's suggesting a 35% decline. Now, Sam, I'd like you to play this video or this audio from Ray Dalio, because he was asked whether he thinks the dollar could be in some trouble with respect to its reserve currency status. Go ahead and play that, Sam.
Is there a real threat right now to the US dollar's status as the world's reserve currency?
Yes, there is a threat. It's an evolutionary type of process. There's not yet a good alternative in the form of a currency per se, but people are not investors, big, large institutional investors don't run out necessarily to alternative currency, because the three major reserve currencies all have the same basic problem. That's why they move into a new storehold of wealth. And you see that the storehold of wealth, like in 1933 reaction, is equities, is gold, is other asset classes that go up. So when you buy a company and you have low returns on your bonds and so on, that is that kind of movement, but the same is true for gold and other asset classes. If that gets too far, and it's standing the risk of, it's very dangerous. It looks like a currency defense. In other words, if those who are holding bonds, which are a lot, choose to sell the bonds because they're not providing a good return, and they're not, and because there's so much debt production and debt monetization, that puts the Federal Reserve or other central banks in the very difficult position of operating like a currency defense. Mechanistically, as money leaves that debt, that means either interest rates would rise, which would be terrible for the economy and markets, or they're forced to buy more and more. And that is how a spiral could occur.
All right, that's Ray Dalio, and he's certainly putting his money where his mouth is. A big gold bug, doing extremely well with gold for his investors as well. But I think he makes the case very well. Just like to, with the couple of minutes I have left here, the U.S. dollar index monthly. Michael Oliver is a person I have on my show every other week. Michael is the best technical analyst that, for me personally, that I've ever had. His momentum work has just been stellar. You pay attention to Michael's momentum work, not to the price charts. And the momentum work had him going short on the dollar, or at least getting out of dollars back in May. He's convinced we're in a bear market, notwithstanding the rally that we've seen in the price in the dollar index recently. And as for gold, Michael says he's not in the least bit worried. Again, looking at his momentum chart at the bottom, gold momentum is above two trend lines. He's extremely comfortable. And when gold gets hit really hard, as it has a couple of times recently, he's not at all concerned. And this has been so helpful to me because it keeps me from getting nervous and keeps me from getting whipped in and out of the markets. So Michael is very, very valuable, not just for these markets, but virtually everything that he does. I find him extremely, extremely helpful. Just like to show this chart because I think it's a beautiful sight to behold if you're a bull in gold. This is the monthly average gold price going back to 1995. This is what I used to chart when I worked at ING Bearings in the mining and metals department there. And you know, I like to keep track of the average price of gold because that's more in line with what companies are going to be getting paid for the sale of their product. So that really brings me to the end of my presentation. I think that just in summarizing, what's important is this zero bound time when interest rates hit zero and when they can't raise the rates anymore. You know the system is broken when that happens, and all they can do is go into fiscal policy to get money into the hands of the masses who are broke. And that's the only thing that will work, not only from an economic point of view, but probably from a stability point of view. As we're seeing riots and all kinds of things taking place in the United States, I think it's in part due to the financial situation, the fiscal, the lack of rectitude and the reckless behavior of piling debt on debt until the system breaks down and Mother Nature says, you can't do this anymore. And I think that's where we're at now. Now, this is extremely bullish for gold. And so those companies that are producing gold, finding it in the ground, just like the 1930s, I think that's where you need to be in markets like this. And so I'm really delighted to have the three companies that I invited here: Puma Exploration, Novo Resources, and Amanica Mining and Metals, each with unique stories, three of them that I love very much and own myself.